Hi, everybody. It's Coach here, otherwise known as Dr. Kevin Spellman, to talk to you about government policy. So, what are we going to talk about? We're going to talk about fiscal policy and monetary policy, and then we're going to compare the two policies together. So, what is fiscal policy? Well, this is central government policy. We're going to talk about outlays and receipts, automatic stabilizers, deficits, debts, the economy, what they did during COVID, and we'll talk about this debt limit, which every once in a while politicians like to argue about. We'll also talk about central bank policy or monetary policy. We'll look at the tools that central banks have at their disposal. Look at this Fed balance sheet, which has just grown like crazy the last 15 years. Over $8 trillion is in it now. We'll talk about interest rates or yield curves and how that tends to lead recessions. And we'll talk about an equation and unfortunately, our central bank forgot about or ignored or thought wasn't important anymore, which may have led to a lot of inflation. It's money supply times velocity money equals price times quantity. And we'll look at the central bank policies during the COVID crisis. Like I said, we'll compare fiscal and monetary policies at our conclusion. So let's talk about fiscal policy. We'll talk first about outlays and receipts. We'll get into stabilizers and these other topics. The first thing is, I have a question on top, but I really don't think it's a question, is government spending countercyclical? So what do I mean by countercyclical? It means it runs opposite of their overall GDP. So in gray on the top here, I show you the GDP growth. And you can see back here during the financial crisis, GDP growth was negative. So that was a recession. Government spending, though, on the other hand, went up. So it went opposite of the economy, or is counter-cyclical. Now, when the economy came out and started doing well, look at what happened to the gray line. It went down. So it tends to run somewhat opposite. Now, what runs with the economy in exaggerated fashion? Investment spending, that's housing and business spending. We've talked about that in a different class session. It tends to be very volatile. Consumption tends to be a lot more stable, and most times COVID was maybe an exception to that. But government spending tends to be countercyclical. Now on the bottom, I'm showing you the total amount of outlays or spending as a percent of GDP. It runs about 20% of GDP over time. This goes back to the 1980s, so nice long history of multiple cycles in here. When does it go up? Well, early 1990s, we had a recession. So it went up as a proportion of the economy. GDP went down and its spending went up. So of course, its outlays as a percent of GDP will go up. Here's another recession, a financial crisis. Here's the COVID. So you can see it running a little bit hot, lots of outlays to GDP during bad times, and maybe during good times, it's not going up as much as GDP. So let's look at the composition of receipts and outlays a little bit more. Receipts, remember, are tax revenues, and outlays are spending. So the tax revenues are on the left, spending's on the right. Let's first of all talk about the tax revenues or receipts. I have a question here, or two questions. Why are Social Security receipts and corporate taxes declining? So let me show you what line I'm talking about. Here's Social Security receipts as a percent of the total. It's been going down over time. Here's corporate taxes also going down as a percent of total. So just pause for a second and think about, what do you think is going on that's causing these to go down as a percent of the total? All right, so here's the answer. Corporate taxes have been going down because we've been reducing tax rates for corporations, not just over this period of time, which is 20 years, but really over like 40 years or more. So tax rate's been going down. Social Security receipts are going down. You'd think, well, more people are retired, so you'd think that's going up. Well, remember, the Social Security receipts are taxes on the existing workers. Well, if fewer and fewer older people are in the workforce, and Social Security taxes a percent of income, and they make more income than the young people, then the Social Security receipts should go down over time as these older people drop out of the workforce and you're left with more young people. And that's what's happening here. Now, outlays, first of all, let's look at the biggest one. Social Security is the biggest in outlays. Oh, by the way, individual taxes dominates tax revenues, and then Social Security second, and corporate taxes are third. But the spending, 26% is on Social Security spending. Then we got health and income security and defense, 16%, Medicare, and then we got interest around 11%. And all these things, well, not all of them, but a bunch of them have been changing, importance over time. So I have a question here. Why is defense going down? So defense is this gold line, has been going down as a percent of total. Well, back around this period of time, politicians, both Republicans and Democrats, were arguing about the size of our deficit. And there was a compromise. And the compromise is, in order to reduce one part of the budget, we needed to, in order to convince the Democrats to maybe reduce one part of the budget, the Republicans have to give up something they really like, which is defense. And so defense spending as a percent of the total went down. So that was a compromise, and that was all about our debt limit, which we're going to talk about a little bit later, some slides from here. So that's why the defense went down. Why did Social Security rise? Oh, by the way, this also went up initially because, of course, Iraq wars and Afghanistan and stuff like that. So that was higher over this period of time. Social Security has been rising. So Social Security is the blue one. So if you look here, it's been rising as a percent of our payments over time. And again, that's the people retiring. And health is rising for the same reason. So if you look at health, it's been growing as a percent of the total for the same reason. But interest expense, kind of maybe surprisingly, the green, going all the way back over to 20 years, there's been times where it goes down and up, but generally it's been relatively stable over time. And right now it's about 11% of our spending. Now, why is that maybe surprising to some people? Because we know that the amount of debt has been going up. Well, if interest rates on the debt go down, you can have more debt, and it doesn't eat up a bigger portion of your budget. Now, after this class session, we'll be talking about employment, inflation, and interest rates, and this will come up again. Right now, our interest rates are not really normal on a relative basis to inflation, not even short-term inflation, long-term inflation. Interest rates are really, really low. If interest rates, let's say, doubled, this would double and start eating into some of our other ability to spend. Now, I also have here what went on during COVID. So we have a couple big bumps up. So this line here, I believe, is income security. This is our unemployment compensation that went up, way up during the COVID. And this other, this 4%, which has come back down to 4%, also went way up. That's like the extra stimulus checks and some other things the central government did in order to jumpstart the economy. So let's look at some of the things that the government can do so their budget kind of runs counter-cyclical to the economy. So we have some automatic stabilizers that kick in when times are bad. So when times are bad, people have lower income, corporations have lower profits, people lose their job. So if there's lower income, there's lower taxes, so receipts go down. And if they're unemployed or underemployed, they may get unemployment insurance, which means the spending goes up. They may go on food stamps, they may go on Medicaid. So it turns out that unemployment rate and the deficit are normally inversely correlated. So this is this graph up here. So if you think about a gauge of the economy as unemployment rate, when the unemployment rate is going up, the economy is bad. And when unemployment rate is going down, the economy is good. If there is these automatic stabilizers where the government spending and taxes run opposite then when unemployment is going up, you would expect the deficit, which is just spending minus outlays, and I'm doing this as a percent of GDP, would get worse. And that's exactly what you see here. Now, there was a period of time here in the, let's see, late 1990s, we ran a surplus. But generally, our deficit is a negative as a percent of GDP, which means our spending is greater than our tax revenues. But we had a very interesting thing here, and maybe a couple other times in history, where we ran a situation where our taxes were greater than our spending. But generally, it's negative. Now, how negative is our current one compared to normal? So if you look at this just graphed differently in a scatter plot, when the unemployment rate goes down, our deficit tends to get better, or it gets smaller as a percent of GDP. When we enacted the tax cuts back in 2017, we were running a pretty good unemployment rate, but not a really good deficit as proportion of GDP. Typically, with that type of an unemployment rate, you'd be running much closer to a budget balance. And why do you want to do that? Well, during good times, you want to save for the rainy day. You want to build up your piggy bank of cash to save for the times when it rains, recession. So you want to run generally a really low deficit during good times in order to basically spend a whole bunch during bad times. So this was COVID. COVID, the unemployment rate jumped to 6.3%, and our tax revenues went way down, but our spending went way up. So our deficit as proportion of GDP went to 18.5%. If you run a very low deficit during good times, and you have enough debt capacity to run a big one in bad times, and that's a good thing. Where are we back to today? Really, really good unemployment rate at a 4% deficit GDP. That's like a head scratcher, because you would expect in history, this goes back to, remember, the 50s, you normally would be much closer to a budget balance at that point in time. So stabilizers, reducing taxes, increasing unemployment compensation, and other things are like a good car that jump starts the bad car with a dead battery, meaning the economy is dead, we're in a recession, we need a strong government to be able to cut taxes, increase spending, in order to put some fuel into that and juice into that car so it can get back running and drive you down the road. Now, this deficit lags real GDP by about 9 months. So that's what I'm showing here. So this is real GDP, and I'm leading the black line to the deficit as a percent of GDP by 9 months to have everything line up. So why does it take a little bit of time for the economy to get worse before these stabilizers kick in? Well, one loses a job before they get unemployment compensation. One's income declines before you're in like refunds on taxes. It also takes some time for the government maybe to enact stimulative policies that they often do during recessions. Coming down here, here I'm looking at spending minus receipts as a percent of GDP. Here, I just show you the spending, the outlays, and the receipts, the tax revenues over time, and the shaded regions are recessions. So let's just take a look at the financial crisis. It took just a little bit of time before outlays to start kicking in, the automatic stabilizers, and for tax receipts to go down after the recession kicked in. And it sees about the same thing in all these recessions. Now, right now, the government, the central government's running a 4% deficit GDP. I pointed out on the last slide, this is not really very good. However, the states are printing money. Their situation is a positive budget balance situation. Really, now the arguments of politicians and a lot of state governments is how to spend the money and how to decrease the taxes. Know what I say to those people? Save for the rainy day, because it will be coming, which is the next recession, and you'll need that good situation in order to deal with things at that point in time. I'm often a person that thinks long term, but unfortunately, politicians, they have to be reelected every few years. There's sometimes, unless they want to lose their jobs, they think short term. Now, my personal opinion is, if you're in a leadership position, lead, even if it's going to cost you your job. Let's look at what the US did versus the rest of the world during COVID-19. So on the top right, this is a Federal Reserve study. They looked at the US spending on the central government relative to their deviation from projected spending. The US basically outspent the world. um, advanced economies and emerging market economies, we had way more government stimulus in the US than other parts of the world. And did that help? Well, this is our mobility, or what happened to the economy. We went down less than the rest of the world, as far as the mobility. Okay, now adjusting for this and then we went back up maybe a little bit quicker. Now adjusting for this mobility, did the increase of spending result in a better economy? So if you look at the US, this is basically what may have happened to the economy on its own, and this is what happened with the fiscal support. So nearly, maybe, let's say 40%, it looks like on there, of the increase goods consumption was a result of the US spending. And the goods consumption is a part of the economy, so that helped out the economy. Now, the problem is, if you remember from a prior class, goods consumption is a small part of overall consumer spending. Most of the consumer spending is on services, but the services part of the economy, going to a restaurant, going on vacations, travel, all that stuff, that even going to the doctor, if it wasn't for COVID, it was closed. So we spent all this extra money on unemployment compensation, extra checks, but we couldn't spend it on services, which is like 65% of consumer spending. We had to spend it on goods, and there wasn't enough goods. No, why isn't there enough goods? Well, anyone that manufactures the goods, you don't want to have extra inventory lying around. They run just-in-time inventory systems. So there ton of people wanted to buy goods, and there wasn't enough in normal times, and then definitely not enough if that's where all the spending was going. And then you had COVID manufacturing related shutdowns, and what happens? That results in a lot of extra, inflation. Okay, so goods consumption went up, and but in order to get there, we had to pay people a lot more, pay a lot more for raw materials, and that all was quite inflationary. Okay, let's talk about government debt. Title of this slide is It's Mounting. So let's look over here. This is the federal debt as a proportion of GDP. So, and I'm taking you back to the 70s. So you can see it's been rising over time. This is, again, the financial crisis, where it rose quite a bit as a portion of GDP, as the deficit was really, really negative, as spending went way up. And it also spiked up here with COVID as our deficit got way worse. So over time, this has been rising, rising, rising. But remember, I said earlier that the part of spending that's based on interest payments hasn't been. That's because interest rates have been going up. So it's almost like the central bank policies on interest rates have allowed the government to outspend its tax revenues and keep running up the debt to the GDP. All right, so on the left, the state and the local debt. Now theirs is much more stable, and it's actually at a pretty good level compared to history right now. States are supposed to balance their budget. Now you say, well, if they're balanced budget, why is there debt? Well, of course, they balance their budget, so let's say it's balanced now. Well, you go in a recession, your spending goes up, your tax revenue goes down. Well, during that period of time, you have more debt. So every once in a while, the debt builds up, and then during good times, maybe the tax revenues become more to spending, it comes back down. They look all right right now on states as their debt is a proportion of GDP. It's the federal government that looks like this is, been continuing to rise. Up on the top right is just looking at the total amount of debt from the various sectors of the economy over time, and you can see the government debt, federal government debt, has been rising kind of as a proportion. This is the banking, the financial debt. It's been about the same here, right? But the economy has been growing, so the total amount as a percent of the economy would have been going down. This is household or consumer debt. So if you look at this, this is approximately the same proportion as it was back here at the financial crisis, where they had too much. But again, their income's gone up, so maybe they can afford that a little bit more. Over here, is non-financial business debt. That's also gone up a lot, okay? So government debt and non-bank corporates have been rising as a percent of GDP, where financial and consumer has been going down. I showed you in another class, the total amount of debt as a proportion of GDP is just as high now as it was at the peak of the financial crisis, which is kind of a little bit alarming. And all we've done is traded a financial crisis and a consumer crisis of too much debt, and now we have the government and non bank corporates having a lot of debt. Now they can afford it if interest rates stay low. If they don't, then all bets are off, and we'll see what happens. Can the government manage this debt level? So I have an equation on the top right. If you think about GDP, this is green, that's your ability to pay debt. It's like the total amount of spending and productivity and the whole works of the economy. So if you think about it, it's all the sales of the economy. And you collect the sales and you say, well, some of the sales has to be to pay the interest on the debt. So the debt is the negative. Your capacity to pay debt is, you think of GDP, the amount of debt is what you have to pay. You want to keep that debt to GDP probably stable over time. If it's rising, that means you're spending too much, or you're not taxing enough. So generally, this will go up as if your deficit is a bigger proportion of your GDP than your GDP is going up each year. That's generally the case. I have some graphs to prove this to you. Generally the case, that is. So let's look at here. Your federal debt to GDP was going down. So if that's the case, then my GDP should have been rising more than this is rising each year. Well, how much this rises each year is really a function of the deficit. Again, deficit is spending minus tax revenues. So the deficit as a proportion of GDP was getting worse over this period of time, but growth was even getting more better. How about to say that? So this was going up quicker than this was, and the overall amount of debt to GDP was going down. Now, what's happened since the 70s? Well, the debt to GDP has gone up, growth has slowed, but the overall deficit as a proportion of GDP has grown. As a result, this rises. On the bottom graph, I'm showing you the same debt to GDP, but this time I'm taking the gray plus this negative, which is the gold, and I'm putting this in the gold down here. So when this is positive, the total amount of debt to GDP goes down. Now, it's still positive here, right? But this is rising. So it's like, what in the world's going on? Well, what in the world's going on? I'm explaining it right over here in this table. So I said it's generally true that if GDP is growing faster than the deficit to GDP, that the debt to GDP declines. It's generally true, but the level of debt to GDP also matters. If the debt is greater than 100% GDP, you can run bigger deficits to maintain this debt to GDP level. If the debt is less than 100% of GDP, you got to run smaller deficits to maintain your overall level of debt to GDP. That's counterintuitive, or not quite intuitive. So let's explain this with the math. Let's first take a situation where debt is greater than 100% of GDP, like it is now. Let's assume debt is 1,100 and GDP is 1,000, or the debt to GDP is 110%. And that's the beginning year. Let's assume GDP grows 5%. So this goes from 1,000 to 1,050, and we have a deficit as a proportion of GDP of 4%, or $42 it is during this year. Well, how do I get 42? 4% of 1,050 is 42. So my debt rises from 1,100 to 1,142. Now, what's my new debt to GDP? 1,142 divided by 1,050 is 108.76. My debt to GDP went down because my GDP growth grew quicker than my deficit GDP. So you say, coach, that's exactly what I expected from these graphs. Haha. But it also goes down if my deficit to GDP is exactly the same as my GDP growth. So let's do this example. This time, GDP is growing 4%, okay? And my deficit is 4% of the 1,040 or 4,160. I add 4,160 to 1,100. My new debt to GDP, my new debt is $1,141.60. This is a proportion of this. This goes to 109.77, also down. So if your debt is greater than 100% GDP, you can, run a deficit the same pace. So your deficit GDP can be exactly the same as your GDP growth, and this actually goes down a little over time. Now, when your debt is less than 100% of GDP, it's exactly the opposite. I'm going to skip the first one just for sake of time. Let's go look at this one. Let's say you start at 1,000 in GDP and it goes up 4%. But this time, the 4% deficit, which adds 4,160, so 4% of 1,040 is 4,160, my 800, so I started with 800 in debt, 1,000 in GDP, or 80% debt to GDP. This 800 rises to 841.6 with this deficit, and look what happens to the ratio. It started at 80%, 800 divided by 1,000. It went to 80.92. So even if your debt deficit to GDP is the same rate as GDP growth, when you have a lower amount of debt, your ratio rises. But when you have a high amount of debt, you can run a bigger deficit and have your ratio go down. The math of this equation provides a disincentive for the politicians to get together and deal with a really high amount of debt to GDP, high based on historical standards, because they can run bigger deficits and maintain our ability to pay the debt or our debt to GDP ratio. So politicians argue as they argue. It's not really probably a surprise to you. So what are they arguing about right now in 2022? Well, they're bringing up old issues which have been argued about over time. They're arguing about the debt limit. So going back to the 1950s, this is the number of times the debt limit has been raised. It's nearly 70 times since the 1950s we raised the debt limit. What is the debt limit over that period of time? Right here. Okay, so we're now over $30 trillion in debt in the US economy. Now, you have to think about it. We're a $25 trillion economy. So we have a lot of ability to pay that debt. But 30 trillion, as a percent of GDP is still, a very, very high number compared to us historically. Normally, it's a non-event. It's a non-issue to raise the debt limit. The economy gets bigger, you have more capacity to pay your debts, so they just raise it. But every once in a while, there's an argument by politicians. Let's back up a little bit before we talk about the arguments. We've had a debt limit that's been raised over time since 1917. What is the purpose of this debt limit? Well, my guess is to make politicians pause and think about their spending and their tax plans. If they are financially prudent and every once in a while they have a pause to think about, what they're doing, that should lower the cost of capital. If you have a lower cost of capital, then more good projects, more projects can be accepted, which helps grow the economy. So that helps growth. So that's a good, that, if it's done right, to have this pause every once in a while. Although, if the pause and the think about the debt limit happens and they don't raise it and we default on the debt, which can happen, and we have defaulted on our debt in history, that should raise the cost of capital. And since the US government debt is kind of the risk-free rate that every other interest rate is benchmarked to, if there's a higher cost of capital for the US government, then there's a higher cost of capital for corporations, which means they can't accept as many projects to grow their business, which will slow growth, slow employment, cause the stock market to go down. That's a problem. And we sometimes, we meaning everybody in this country and their politicians, they vote into office. Every once in a while, there becomes a big argument that leads to a crisis. 2011, 2013, 14, we came within days of defaulting on our debt. So I'm kind of doing a snapshot here, so look at it a little bit closer. You can see the amount of the debt limit, which is the gold, and the amount of debt we had, it came really, 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 really close to going above that limit. Now, what happens if we run out of cash? Well, the government shuts down, okay? People aren't paid. We start missing interest payments, and our debt was downgraded. Now, at the moment, sorry, I said 2022 a little bit ago. It's 2023 that politicians are arguing about the debt limit. Right now, we're spending more than we have tax revenues on, but our treasury ran up a huge cash balance. And they ran up that cash balance probably in anticipation of this back in 2022, this being a political issue. Eventually that cash runs out. And if the cash runs out and we don't basically vote on increasing the debt limit where we can get more cash, then of course government shut down, we have to miss interest payments. My guess is we first stop paying people before we stop paying those we owe on the debt. So it could go on months, but the Treasury anticipated this and they built up cash balance. And more than likely, the politicians, looking at history, probably won't fix this until we're days from crisis. So we have that to look forward to in 2023. Okay, let's talk a little bit about monetary policy. Talk about the tools, we'll talk about the yield curve, we'll talk about the Federal Reserve's balance sheet, and this equation I said is very, very important, which I think our central bank missed the importance of this and also resulted in a lot of inflation. And we'll talk about their policies during the COVID crisis. So first is Fed tools. What can the Fed do? Well, the Fed's tools are mostly to influence interest rates. So if they influence interest rates, they can control this cost of capital, which influences investment by corporations and also influences spending by individuals. How do they influence interest rates? Well, really 4 different ways, but it can be more because they did some extraordinary things during during COVID and also the financial crisis, which we'll talk about a little bit later. First is open market transactions. They can buy and sell bonds, and that influences the Fed funds rate, which I think is named wrong because the Fed's funds rate is the rates that banks borrow from each other, where the discount rate, which you may have heard of, is the rate that banks borrow from the Fed. I would have thought this would have been named the Fed funds rate and maybe this one named the discount rate, because the Fed directly controls the discount rate and they indirectly control the Fed funds rate. So let's talk about how they control the Fed's fund rate first. So to lower rates, this is what, to lower rates that banks borrow from each other, and banks, if a bank's short on cash and there's a reserve requirement ratio, then what a bank has to do is borrow from other banks that have excess cash. In order to lower rates, the Fed wants more banks to have excess cash. So what does the Fed do? They buy bonds. If they buy bonds from people, that gives people cash that they put in the banks. There's more banks that have excess cash, and they don't want to have excess cash not earning any money, so they lend to other banks. And there's fewer banks with less excess cash, and lots that have lots of excess cash. So the rates that the banks that are short will be lower. Because if there's a lot of supply of money and a little bit of demand for money, then the ones that demand the money won't have to pay as high of an interest rates. And if the interest rates go down on the Fed funds rate, the rate banks borrow from each other, then they're going to have to, they'll charge less on maybe a mortgage loan because they have a lower cost to borrow. Fed targets a rate within 0.25%. So this is indirect, buying and selling of bonds in order to influence this Fed funds rate. Okay, now they may do some other things there too to control that. Changing the discount rate. This is the rates that the Fed charges banks to borrow directly from them. They tend to borrow from other banks before they borrow from the Fed, because if they're borrowing from the Fed, that probably means other banks are not willing to lend to them and they're going to get a little bit more scrutiny. This discount rate and the Fed's funds rate tend to move together. This is changed frequently, okay? The reserve requirements are not changed very often. The reserve requirement is basically how much cash banks must have to meet potential withdrawals. They don't want extra cash sitting around because that's not making them money. They want to lend out that extra cash. And it could be also costing them money because there may be some interest rates on bank deposits. To increase access to capital, what the Fed can do is lower the amount that the banks have to have in the safe reserves. And then more money is freed up to go in the system. If there's more money that banks can lend, then that means there's more lenders. And if there's not more borrowers, that lowers interest rates. And this, it doesn't happen as often, but it did happen during COVID, where they reduced this standard quite a bit in order to encourage banks to lend. There's also just the Federal Reserve talking about what they're going to do. But in order for the talking to work, they must have credibility. So this is March 17, 2021, a press conference. I won't read it all. You can read it on your own, pause the video. But this is what the Powell said. I would note that there's a transitory rise in inflation above 2%. It seems likely to occur this year, but that does not meet their standards. You know, they target 2% inflation, but they said, don't worry about it because it's transitory. Now, did that influence interest rates? Well, at that period of time, March 17, 2021, inflation was really rising. If the market didn't believe that the inflation was rising, then interest rates would have gone up, but actually interest rates went down on the 10-year bond during that period of time. Interest rates are a function of inflation. It'll be in our next class, we'll be talking about those relationships, but generally, if there's higher inflation, you need a higher interest rates in order to be willing to lend to people and delay your consumption and then have to pay higher for that consumption a year later. So interest rates should go up if there's higher inflation, but we had really high inflation here. Powell and central bankers convinced everybody it was going to be temporary, and interest rates actually went down. That works if they have credibility. So the main thing that the Fed's doing is changing this Fed's funds rate. So there's a lot of information here. I want to go through each thing in turn, just to help you understand this. So I'll read a lot on this slide. The Fed changes the Fed's funds rate and the discount rates through the ways I said on the prior slide to influence the cost of borrowing. This is a short-term rate and therefore a lower risk. So all other rates are essentially benchmarked off of this. If the Fed funds rate rises, then other rates rise, all else equal. There's other things that go into this. The Federal Reserve's goal is maximum employment and price stability. So this Fed funds rate varies based on inflation, the control inflation, and employment. So let's look at this graph over here. The Fed funds rate is the gold shaded area. The inflation rate, excluding the volatile food and energy, this is the growth rate of inflation, is the red. The unemployment rate, which is the employment part of their goals, is in the black. The Fed tends to target 2% inflation over time. So what will normally happen is the Fed funds rate rises above inflation towards the end of the cycle when inflation is running hot. So let's look at this. Let's just take this cycle here. Inflation was, right around, let's say 3 to 4% here. The Fed funds rate was rising or at a rate above inflation over that whole period of time and actually rose towards the end as the economy was getting better and the unemployment rate was going down. And you'll see that the Fed funds rate tends to peak above inflation, is peaking above inflation here, and it tends to go up when this unemployment rate's coming down. So unemployment rate coming down, inflation's kind of going up, Fed funds rate going up, unemployment rate coming down, so people are fully employed, inflation's starting to go up, Fed funds rate goes up, etc. It happens in most cycles. 2010s was different. The Fed funds rate was set at 0 for a really long period of time, and it never got above the inflation rate. Now, over this time, inflation was relatively low, and frankly, the Fed was worried that inflation was running too low. If inflation's too low, it discourages spending. So you want to have inflation positive, but not too high, because if inflation is positive, it encourages people to invest and spend, and investing and spending is the economy. Well, at this period of time, we were worried about inflation being too low and not encouraging that spending and investment. It took a long time over that period of time to bring down unemployment from really high levels during the financial crisis. Why was that the case? Why was inflation low? Why was this cycle, it took so long? Well, remember, right here, consumers and banks had too much debt. So when we had the 2010s, banks and consumers were fixing their balance sheets. So instead of lending, banks were building up their capital. And instead of borrowing and spending, consumers were fixing their balance sheets. So the Fed had extraordinarily easy monetary policy during this whole period of time, which was a slower growth time with lower inflation. The Fed missed it. What could happen to inflation this time, because they're focused on this last time when interest rates were really low, and they thought we could lower interest rates again and keep them really low during COVID, and we're not going to have inflation because we didn't have it last time. But look what happened to inflation. Fed had really low, 0 rates until just recently. And inflation just rose like crazy. Well, it was a very different environment than back here. During and post-COVID, banks were eager to lend. Remember, banks didn't have as much debt as a portion of GDP, and consumers were way better off, and they were eager to spend. They had all this extra paychecks from the central government to spend, and their debt as a proportion of GDP had come down. The Fed missed this. And of course, their spending was on goods, which was running just-in-time inventory system. So people had way more to spend, very low interest rates to be able to borrow. Consumers couldn't spend on service, which is the majority of spending, so they spent on goods that run with just-in-time inventory system and had COVID supply chain disruptions, and inflation then spiked for goods. Of course, if people are spending on goods and their inflation for goods is higher, then they're going to demand higher wages. And then workers were fully employed really quickly. That means wages go up, which means for the service side of the economy, that makes inflation go up for the services too. We got this whole inflation problem. And the Fed had to be more aggressive raising interest rates than they ever have that short a period of time, going back to at least the 70s. We're going to talk a lot more about what's driving inflation in the next set of classes. Okay, so let's talk about the yield curve. The yield curve is basically the relationship between long-term rates and short-term rates. And the yield curve can have many shapes. Generally, the normal shape is upward sloping. Interest rates are higher on long-term bonds than short-term bonds, but it can be inverted, and it normally is before recessions. It could be humped, it could be flat. And there's many different theories for why the yield curve has these shapes. So one is pure expectations. The shape of the yield curve is determined by expectations of future inflation. If the market thinks the future inflation is going to be higher than it is today, then it'll be upward sloping because you have to have a higher interest rates to compensate you for the long-term bonds where there's going to be higher inflation. Currently, long-term rates, this is the gold, are lower than the short-term rates. So that must mean, and we have a hump situation, that the market participants, which generally drive the long-term interest rates, must think inflation is going to come down relative to where it is today. Inflation normally comes down in recessions. So this is an inverted yield curve. Even this short rate is higher than this long-term rate, okay? So we kind of have it inverted, but it's really kind of a humped. The Fed may be here at the end of the year, which then would be inverted more like this. Now, the liquidity preference theory would say the shape of the curve is dependent upon expectations for future rates, but also for extra risks associated with investing in long-term bonds. Based on how the math of the equation works, if interest rates change, the volatility of long-term bonds is higher than short-term bonds, so you'd expect long-term bonds to have higher interest rates for that extra risk is implied by volatility. So the normal shape of the yield curve is positive. There's also a market segmentation theory that says the interest rates determined by the demand for investment vehicles along the different maturity, okay? So that's the yield curve generally in shapes. This is what it looks like before recessions. Normally there's an inversion. An inversion is where long-term rates are less than short-term rates, and it precedes recessions. Short-term rates are influenced by the Fed, as the short-term rates are much closer to the Fed funds rate and discount rate, and long-term rates are more influenced by market. Not perfect, because the Fed can also buy up long-term bonds. What I have over here on the left is the yield curve, the 10-year rate minus the 3-month rate. Normally it's a positive. The black is normally positive. And then I have real GDP growth in the shaded. Normally this becomes a negative before a recession. There's a recession. This was actually a recession. That's a recession. You see it's negative before it. So very good forecasting. And this time I look at 10-year versus 2-year, and you actually see the same thing. It tends to, right now, become inverted before recession. Right now, we have a reasonably large inversion. So the financial markets on the interest rates are forecasting that they expect a recession. Now, if you look at shorter term rates, the 2-year rate on the Treasury tends to lead the Fed funds rate, and I have the 2-year Treasury and the gold leading the Fed funds rate by 3 months. Also point out that the Fed funds futures that the Fed have pretty much gotten this wrong. They consistently underestimated how high rates would go. So this is the market's expectation back in July of 2022, what they thought the Fed funds rate would be over different periods of time. This is what it was back then. And by the way, the Fed's dot plot is what they advertise, what they expect, was also much, much lower back here. The dot plot now, in the latest that the Fed has given us, shows that they expect interest rates kind of peak out at 5.25. And since the time I did these slide decks, it's gone up even since that point of time. And if you look at the futures or the Fed funds futures curve, they actually were expecting the Fed funds rate to peak a little bit less than the Federal Reserve thinks. but both expected to come back down in 2025. Probably that would happen if they think inflation is going to be under control or there's going to be a recession. Let's talk about the balance sheet. And it's not focused on enough, probably, as far as its influence on inflation. And we'll give you a quote by Paulo in a little bit and why this is really, really important. So first of all, some perspectives. This is the amount of the Federal Reserve securities, FR's Federal Reserve held. That number there is over $8 trillion. Again, in perspective of the economy is, 25 trillion or so on a nominal basis. So a quarter of the economy, a quarter of the spending of the economy and debt is just held by the Federal Reserve. Remember, the total amount of government securities, now this also includes some mortgage securities and other things, is over 30 trillion. So the Federal Reserve single-handedly over this period of time basically bought up probably every additional dollar of debt that the central government issued, and did the exact same thing here. Now, if they weren't out there borrowing and lending to the central government, what would have happened to interest rates? If when the government ran these huge deficits, the Federal Reserve wasn't willing to basically lend them, the government would have had to get the money from someplace else. And if they had to get the money from someplace else, they may have wanted a little bit higher interest rate. So that's a very important thing to think about. I'll run through these slides. So if you look here, this is looking at the annual change in this balance sheet. And this is looking at the ISM PMI, as we've talked about how important this is as a gauge of the economy and why I tend to use this instead of GDP as a gauge of the progression of the economy. But you can see every time the Federal Reserve started buying up these bonds, the economy improved. And down here, I'm also showing you the relationship to the stock market. And it seems to be the stock market kind of goes up, also in line with what the Federal Reserve is doing on this balance sheet. Okay. This, if you go back to the financial crisis, is like quantitative easing 1, QE1, QE2, QE3. And this was about 4 trillion added to the balance sheet over years. Let's say 2008 to 2014. So there's quite a few years, right? And then they maintained it stable for some time. The amount we did here on the central bank's equivalent to quite a few years of stimulus spending after the financial crisis, and this was the COVID, okay? So if you buy up securities, you put more cash out in the system, that lowers rates, increases the liquidity, increases the supply of money, okay? That seems to be correlated with market. The money, it buys securities, puts cash in someone's pockets, must go someplace. Let's walk through this. If the Fed buys bonds and it doesn't care about the value it pays for it, and they don't care about the interest rate, that pushes down the interest rates because the coupon set on the bonds, if they buy bonds, it pushes up price, pushes down the interest rates. Well, bond investors can say, well, I'm not getting good interest rate on my bonds, so what do they have to do? They have to go into more risky bonds, and that pushes down interest rates for more risky bonds, which of course allows these really risky companies to borrow at lower rates, and they survive and they grow. But the problem is the people in risky bonds, we say, well, I'm not getting enough interest rate on risky bonds. I need to go buy stocks that have even more risk. So the buying of the bonds pushes up stocks. Now, of course, the stocks, the value of stocks is the present value of cash flow. If the discount rate that you're discounting those cash flows goes down because of lower interest rates, and people knowing that the Fed will always come to the rescue to the economy, so that lowers the risk premium, the discount rate on the present value of the cash flows goes down. And if interest rates go down, which increases its spending and hiring and spending, then their cash flow on the present value of the cash flow goes up. So that pushes up stocks. Of course, if the stock people own equities don't think they're getting a good enough value for what they're doing, investing in them, then they move to alternatives, private equity, venture capital. And that's all what happened. So we basically end up having a bubble in all these different asset classes, distorted by a central bank that doesn't care about what price they pay. And eventually it becomes so distorted, reality sets in, and we get 2022, which was the literally worst year for stocks and bonds and private equity, IPOs, all that was even worse. I think you have to go back to the 1930s to find a time where stocks and bonds did as bad. And then before that time, there's maybe a few times in the 1800s where it was as bad as years last year, courtesy of the Federal Reserve. All right, let's remember math from equation that you may have learned in economics. This equation is money supply times velocity of money equals price times quantity. Price meaning inflation, quantity real GDP. Money supply, meaning M2 is what I'm going to use, which consists of basically currency in the bank vaults, plus some other things, money market funds and things like that. If money supply goes up, which Fed raised money supply, it must go someplace. This is an equal sign. This is not even an approximation sign. This is not a theory. This is a truth. How they calculate V is they just solve for it. If this goes up 20% and this goes up 10, then that must meant V went down, okay? If the money goes into savings, which means V goes down, it's just how many times this money is changing hand. Savings could be paying down debt or it could be in the financial markets, then V goes down. Now, even if money supply doesn't do anything and V goes down, that influences price and quantity. So this was kind of like after the financial crisis, V went down. Consumers paid down debt and banks didn't lend. So V went down, we had extraordinary monetary growth. V went down enough where Q didn't rise that much, so the quantity demanded didn't rise that much, and prices were pretty low inflation during that period of time. Now, if this money supply goes up and nothing happens with V, then Q will go up if we have enough capacity to provide more quantity. If there's not enough capacity to provide more quantity, like when money supply went up and V was not going necessarily down when COVID happened, although a lot of people did invest in the financial market, so V went down there, but also people were willing to spend. So Q couldn't go up enough and prices rose. This is what a famous economist once said. Let me give you a quote. Inflation is always and everywhere a monetary phenomenon in the sense that it is and can be produced only by a more rapid increase in the quantity of money than output. Output is over here, quantity money is over here. They are ignoring a V. But we had a really extraordinary increase in money supply. This is M2 growth back here in the 2010s, and we didn't have a high growth in inflation. So what Powell said in 2021, early 2021, when he was talking about inflation being transitory, he said, well, in response to a questioning on, hey, isn't Milton Friedman right? I don't know if they said Milton Friedman in this testimony to Congress, but he was questioned on there. He said, well, we've had big growth in money supply aggregates at various times without inflation. So it's something we have to unlearn, I guess. Well, I think Powell needs to unlearn his unlearning because Powell's back in school. The money really does have to go someplace. M2 growth leads change in CPI by about 3 months. So if you look over here, this is just money supply growth, M2, and I'm leading this I'm leading inflation by about 3 months. Okay, so I'm trying to line these things up. And you see, if money supply growth kind of started bottom here and starts to go up, inflation maybe starting to go up a little, right? There are some periods of time where it's not perfect, but that's because there's more to this equation. There's a V, there's a Q. Are we in a recession? Is there extra capacity? So Powell is partially right. As for money supply to lead to inflation, banks need to lend and consumers have to borrow and spend. V must not fall. So if this goes up and V doesn't go down, then this rises. If there's not enough quantity, then price goes up. There must not be, so Powell is partially right, as for money supply to lead to inflation, there must not be a lot of spare capacity to produce. So if this goes up a lot, V's unchanged, we don't have price if Q can go up a lot, if the quantity can go up a lot. But before COVID struck, our economy was running pretty much all out. Unemployment rates were low, capacity utilization was going high. So when we added all the stimulus back then, and then to economy that was partially shut down and we had COVID manufacturing disruptions, it can feed through and lead to a lot of inflation. Let's look at the velocity of money. So velocity of money leads inflation by about 14 months. So you can see the ups and downs. And again, I'm going to talk about some other drivers, secular long-term drivers of inflation in the next set of slides for the next class. So we'll talk a little bit more about that. So it's not just about fiscal policy and monetary policy and inflation. There are other things that matter. We'll leave that to a later class. So let's keep moving on with this discussion. This velocity of money, which tends to be overlooked, actually matters. Markets anticipate velocity of money. So I'm looking here at the stock market return, and I'm looking at the velocity of money. And I'm leading the stock market to velocity of money by 4 months. Now the market's way down. What do they think is going to happen to velocity of money? I think it's going to go down, which means consumers are going to be saving more and banks aren't going to be lending. Now, if you look down here, Loan Officer Survey forecasts this change in velocity. So this is a survey, and I've inverted the right scale. A loan officer is the percent of officers that tighten standards for loans. If they tighten standards for loans, that means there's going to be less borrowing, less lending, less spending. And what's going to happen to velocity of money is going to go down, which means if this goes down, what happens over here? Prices and quantity go down. Velocity of money tends to lead borrowing, okay? So velocity of money matters. Money supply drives the economy and stock market. So what I like to do to figure out if we're going to have a recession or not, which is the question on many people's minds, is what's happening on the left-hand side of this equation and what's happening on the right-hand side of this equation. Money supply tends to lead nominal GDP growth by 19 months. Now, go back to this slide. Money supply growth is negative now. So what's going to happen to GDP in the future? Now, this is not perfect, right? Remember, I'm just doing money supply, not velocity, and I'm doing real GDP, the quantity, not price. But you see sort of the ups and downs go together if I lead money supply to GDP by 19 months. Now, it leads the PMI, which is my preferred measure because it's monthly and there's all kinds of other reasons why we've talked about why I like PMI more than GDP. But it leads that by 16 months, okay? Doing the same thing here. Why do we care about the PMI? It's highly correlated with the stock market. So the ups and downs, they go together. So if money supply is going down, PMI is probably going down, the market's going down, okay? Now, are we going to have a recession or not? It's on everybody's mind. So what I've done here is I've looked at the money supply, ignoring velocity, and I take the money supply growth minus basically, the ISM PMI, which is a proxy for what's happening with GDP, because the PMI leads GDP by about 3 months. And what I've noticed is every soft landing where we haven't had a recession, so this is when the PMI has gotten to below 50. 50 is the contraction line below that for manufacturing. When you've gotten below 50 and you didn't have a recession, always money supply started growing quicker over here above zero than GDP. So the Fed basically put their foot on the gas to get the economy out of recession. This was a soft landing, a recession. PMI went way down. And now they did start increasing money supply, but looks like not until about a year into this, and we had a recession developed here. A recession. Every one of these soft landings was associated with money supply really growing relative to GDP. And where is it right now? It's in this contractionary territory. And that's because, of course, the Fed didn't raise interest rates early enough, and inflation is somewhat out of control. And they need to get inflation back down. That's one of their goals, price stability and full unemployment. And if inflation is too high, that's generally considered bad for the economy. Certainly if inflation is higher than wage growth, which it is right now, which means consumers have to borrow in order to spend, which is a problem, but it leads to a lot of volatility in the economy. So we like to have inflation above zero, but not too high, and not below zero, because if inflation is below zero, that discourages spending and investment. So let's look at the Fed during this last crisis. So generally we know there's 4 tools of the Fed: Fed funds rate, discount rate, reserve requirements, and just I'm talking about interest rates and their policies. But there's other things they can do. And it's very important. Fed has, in the financial crisis, they brokered deals to save banks that were going under. And that's kind of, I'm talking about like the Bear Stearns and Lehman Brothers back in the financial crisis and what Merrill Lynch did. They support money markets. So short-term investments. So where's something supporting money markets? A money market facility. Because when crises happen, even borrowing really short-term, people can't do. If you can't borrow short-term, a corporation can't borrow short-term, then they can't pay their suppliers, they can't pay their workers. Workers then can't pay their bills. Suppliers aren't paid, they have to start laying off people. So they've supported money markets with extra facilities. And they've even, importantly, lent directly to businesses. The Main Street lending program was directly to businesses that they're willing to lend. If banks weren't willing to lend themselves, they could go to the Fed. And then the Treasury was willing to make up for losses associated with the Fed doing those lending. So that was part of the fiscal government stimulus packages. So the Fed's even gotten creative, lending directly to businesses. That's it on the Fed and fiscal policy, but I want to just spend one little bit of time here, a few more minutes, just comparing the two. Fiscal policy, central government, Congress, what is it? It's federal government and state and local tax and spending policies. What they do has a direct impact. If they spend more, that directly closes the economy. If they reduce taxes, that's extra income, disposable income that someone can spend. So it has a very direct impact. Monetary policy, again, is done by the Federal Reserve. They have a dual mandate: maximum employment and price stability. It's indirect impact. They try to influence interest rates that then influence spending and investment, influence the amount of funding available for borrowing. Okay, so it's indirect versus direct. Fiscal can be immediate. The immediate or almost immediate are the stabilizers, where you lose your job, you don't pay taxes, you lose your job, you get unemployment compensation, but it can also be delayed because it could take some time for Congress and the president to act on new legislation to increase spending. Federal Reserve meets frequently, many times during the year, and they can meet in between meetings. They can act quickly. Politics are involved here. Maybe models are involved here, although it seems like the Fed violated some of their own models for where the Fed's funds rate should be. So they can override their models, but they can act pretty quickly to reduce the Fed's funds rate, discount rate, the required reserve ratio, and they can get out and talk to the public in their presentations, where this take a lot longer to pass legislation. There's a lot of decisions to go in here. Many policies and spending and taxes. Here is relatively few decisions. This is a big deal for the economy. The government, frankly, on both fiscal and monetary, they're like, hopefully, the good car that jumpstarts the engine of the dead car in a recession, and during good times, hopefully they run surpluses and raise interest rates in order to stabilize the economy so it doesn't run too hot. Sometimes it doesn't work quite like right. And I think we're experiencing that right now in 2022 and 23 with taxes. Although I will say, even though I kind of told you what they did may result in our current situation, during COVID, we didn't know it would happen. And they needed to be aggressive. And they were. And that may have helped us avoid something much worse. The problem that I have is when we had a vaccine and people started taking it in 2021, that the Federal Reserve and the fiscal policies then start, ratcheting down. And I'm not just telling you this after the fact. I wrote about this back in March of 2000, April of 2000, made a presentation in July that I was concerned about possible inflation implications. If you understand cycles and you study cycles, then it can very much help you avoid, things that get out of whack and maybe forecast some of the things that we're experiencing today. I wish you the best in navigating through this and the next cycle, up or down. Have a great day, everybody.